encourage you to do so, which would be to go onto the plan sponsor website login page, go under the Learning Center tab, and then you'll see videos on the right side of that screen. And I would encourage you to take a look at that. So today, what we're going to be talking about is just a real high-level review of the mandatory Roth catch-up contribution rules, going to highlight some key changes that were made by the final regulations. So the IRS issued proposed regulations in January of this year, then issued final regulations in September, and we're going to highlight some of those key changes. And then our clients that use our pre-approved plan document, we recently sent out a client package designed to comply with these new mandatory Roth catch-up rules. And then finally, we're going to close the hour with a discussion of what you need to do between now and January 1st to comply with these new rules. So first of all, let's talk about what makes a deferral a catch-up contribution. So a catch-up contribution only occurs if a specific limit has been exceeded. And there's four limits that apply here. The first is, and we're all familiar with that 402G statutory deferral limit that says for 2026 is $24,500 maximum deferrals we can put in. So last week, the IRS released its 2026 numbers, and indeed, the deferral limit next year is $24,500. The age 50 catch-up limit is $8,000, and the age 60 to 63 catch-up limit remains at $11,250. So this is the first limit we're worried about. The second limit is this Code Section 415C all-in limit, which is $72,000 for 2026. And this all-in limit means that the total of contributions that can be allocated to a participant's account in the 401k plan is $72,000. So we take a look at total of deferrals and total of all the employer contributions, and we can't go over this $72,000 limit. Next, it doesn't happen very often, but sometimes there's a plan limit. For example, the plan might say that if you're a highly compensated employee, you can't defer more than 10% of your compensation. And then finally, there's this ADP limit. If you have a safe harbor plan, you don't care about the ADP limit because you automatically get a pass on the ADP test. But if you're an ADP tested plan, you know what you have to do is you have to compare the deferrals made by your highly compensated employees. You compare that to the percentage of deferrals made by your non-highly compensated employees. And sometimes if you don't satisfy the ADP test, what you do is you correct it most likely by making a partial refund of deferrals to the highly compensated employees if the highly compensated employee is not catch-up eligible, not age 50 plus, or if the highly compensated employee is eligible to make catch-up contributions, then the plan reclassifies some of those deferrals as catch-up deferrals in order to pass the ADP test. So as a practical matter, like 98% of the time, we don't worry about that 415C all-in statutory test, and we don't worry about the plan limit test because very few plans have problems with these. And so what we're really looking at is that deferral limit 24,500 and the ADP limit. And in fact, if you have a safe harbor plan, you really only care about that 402G limit. So, for example, if I make $24,500 in deferrals in 2026, the next deferral I make will be a catch-up contribution. All the contributions, all the deferrals that I make up to $24,500, those are not catch-up deferrals. So a catch-up deferral or a catch-up contribution only arises after some limit has been exceeded. So with that background, with Secure 2.0 passed in 2022, has this new law that says in 2026, Catch-up contributions must be made on a Roth basis for participants with FICA wages that exceeds $150,000 as adjusted for inflation in 2025. So a couple of comments here. First of all, that last bullet point, uh, any webinars you've been attending, any literature you've been reading on the internet talks about this $145,000 number. Well, last week, as part of its contribution limits, the IRS said that this is $150,000 is the mandatory Roth wage threshold. So what's happening here is we need to find out who, well, what we need to do is find out who our highly paid participants are in 2026. So we're going to call these high wage earners highly paid participants. And so we need to know who our highly paid participants are in 2026. Because if you're a highly paid participant in 2026 and you want to make catch up contributions, those catch up contributions must be made on a Roth basis. So we determine who is a highly paid participant in 2026 by looking at the preceding year's FICA wages. So we look at 2025 and we just ask the simple question, do we have FICA wages that exceeds $150,000 in 2025? If the participant's FICA wages exceeds $150,000 in 2025, that person's a highly paid participant in 2026. And if that highly paid participant wants to make catch-up contributions in 2026, they must be done on a Roth basis. The second point here on this slide is it doesn't matter whether we're talking about the age 50 catch-up or that super enhanced age 60 to 63 catch-up, the rule applies. And when we talk about FICA wages, we're looking at box 3 on the form W-2. Couple important points that are misunderstood is that these new rules don't apply to folks that have self-employment income. It only applies to folks that have FICA wages. So if you've got a sole proprietor, if you've got an LLC member, if you've got a partner who might have $1 million in compensation, but they don't have any FICA wages, they're not subject to these new rules. They can make catch-up contributions on a pre-tax basis or a Roth basis. They don't have FICA wages. The other point is a highly paid participant is not the same as a highly compensated employee. Yes, Congress could have made this simpler for us by just applying these new rules to highly compensated employees, but they did not. They said these new mandatory Roth catch-up rules apply to folks with FICA wages that exceeds $150,000. We're just going to call them highly paid participants. So some highly paid participants might be highly compensated employees. Some highly paid participants might not be highly compensated employees. Some highly compensated employees might not be highly paid participants. So for example, just like that first bullet point, if I'm a sole proprietor and I make $1 million, I'm obviously a highly compensated employee for purposes of non-discrimination testing, but I'm not a highly paid participant because I don't have FICA wages. I could also be a highly compensated employee for a corporation and only have $50,000 in FICA wages. I own the entire 100% of my corporation. I'm a highly compensated employee because I own 100% of my corporation, but I am not a highly paid participant because my wages were only $50,000. So that means I can make catch-up contributions as a highly compensated employee, but not a highly paid participant. I can make those catch-up deferrals on a pre-tax basis or a Roth basis. So we're only looking at box 3 of Form W-2 to determine if we have FICA wages that exceeds $150,000, which means at the end of the year, Union Bank is now going to be asking another question on its annual census questionnaire, and we're going to end up requesting FICA wages, which may be different from plan compensation that you use to determine what contributions you're going to be make to the plan. And so we're going to see we've got some pretty tight deadlines on how to correct some failures that can happen with respect to these new rules. And so you're going to need to promptly complete that questionnaire showing us FICA wages so that we can promptly do some corrections to avoid adverse tax consequences. So if you're one of those employers that are historically a little slow to respond to the questionnaire, you want to make sure that you do respond on a timely basis, especially with respect to these rules. So let's move on to talking about a couple of the key changes that were made in the final regulations. The first is this concept of an employee who's working for two or more related employers. And so employers can be related through the control group rules or the affiliated service group rules. And typically, under the qualified plan rules, if you have two related employers for non-discrimination testing purposes and such, we treat them as a single employer. It's a little different here with the mandatory Roth catch-up rules. So if you've got an employee who works for two related employers, the proposed regulation said that you could not aggregate the FICA wages from both of those employers to determine if the employee was a highly paid participant. The final regulations say it's your choice. You can aggregate the FICA wages from the two employers, but you don't have to. So here's an example. We've got first co and second co are participating employers in a 401k plan. They're members of a control group of businesses, meaning they're related employers. So in 2025, our 50-year-old participant has FICA wages of $130,000 from first co and FICA wages of $130,000 from second co. Under the final IRS regulations, we can aggregate the FICA wages from first co and second co to come up with $260,000 in FICA wages, but we don't have to aggregate. We can just say that we've only got 130,000 from each first co and second co. If we're going to aggregate FICA wages, then our participant is a highly paid participant in 2026 because our participant has $260,000 in FICA wages. That means our highly paid participant, if we're going to aggregate FICA wages, any catch-up contributions must be made on a Roth basis. If we choose not to aggregate FICA wages, then our participant is not a highly paid participant for 2026. That means any catch-up contributions in 2026 can be on a pre-tax or a Roth basis. The next change is this treatment of what I'm calling early year Roth deferrals. So here's our example. The 402G limit for 2026 is $24,500. Our age 50 catch-up limit is $8,000. Our highly paid participant makes $8,000 in Roth deferrals in January through June of 2026. And then from July to December 2026, our participant makes $24,500. Our participant is a highly paid participant. The question is, can we treat those $8,000 in Roth deferrals that were made in January through June before the 402G limit was reached? Can we treat those early year Roth deferrals as catch-up contributions? Now, remember at the top of the program, I said we don't have catch-up contributions until we exceed a limit. And so ordinarily, those Roth deferrals made in January through June 26 are not catch-up contributions because they were made before that $24,500 limit was reached. What the final regulations do is they say you have the option of treating those early year Roth deferrals as catch-up contributions or not treating those early year Roth deferrals as catch-up contributions. It's up to you. covered that. Next, correction deadlines. So here's a little bit of a background here. Let's say we have a highly paid participant in 2026 because they've got FICA wages that exceeded $150,000 in 2025. And our highly paid participant makes pre-tax catch-up contributions in 2026. That's a failure that needs to be corrected because those catch-up contributions were required to be made on a Roth basis, but were inadvertently made on a pre-tax basis. So we've got three ways that we can correct this failure. The first is the plan can simply distribute those pre-tax catch-up contributions plus earnings to the highly paid participant. We just get them out of the plan, make a distribution to our highly paid participant, and we've corrected the failure. The regulations provide two other correction methods that gets away from this concept of distributing catch-up contributions, and we can keep those pre-tax catch-up contributions in the plan if we have a deemed Roth election feature in place. And we're going to talk more about that a little later, but if we have a deemed Roth election in place, what we're simply going to do is transfer those pre-tax catch-up contributions. We're going to transfer those pre-tax catch-up contributions from the highly paid participants' pre-tax deferral account to the highly paid participants' Roth deferral account. And that transfer from the pre-tax account to the Roth account is going to be a taxable transfer. And that same transfer is going to happen regardless of whether we're using the W-2 correction method or the in-plan Roth rollover correction method, which I sometimes may shorthand that to the 1099-R correction method, because the only difference between those two correction methods is how that taxable transfer from the pre-tax account to the Roth account is going to be reported to the IRS and to the participant. Under the W-2 correction method, that taxable transfer is going to be reported on the W-2. If we're using the in-plan Roth rollover correction method, then we're going to report that taxable transfer on the 1099-R. Now, I think as things shake out in the next couple of years, by far the most prominent way to be able to correct these failures is going to be through the in-plan Roth rollover or the 1099-R correction method for a couple of reasons. First of all, that W-2 correction method is only available until January 31st of the next year. So for example, if I'm a highly paid participant in 2026 and I've inadvertently made pre-tax catch-up contributions, to be able to use the W-2 correction method, when we transfer those catch-up contributions that were made on a pre-tax basis to the Roth deferral account, that transfer has to be reflected on the W-2 that needs to be issued before January 31st of January 31st of 2027. So we've got a short fuse to be able to use that W-2 correction method. The second reason why I think it's really going to be this 1099-R correction method is that record keepers know how to do in-plan Roth contributions. And so I think that's going to be the most common way that these failures are going to be corrected. Next thing, the final regulation said, which was a nice pleasant surprise, was what if the plan doesn't allow for in-plan Roth rollover corrections? Can the plan still use that 1099-R correction, that in-plan Roth rollover correction method? And the answer is yes, you can still do it. In other words, you don't need to have an in-plan Roth rollover feature in your plan to use that in-plan Roth rollover correction method. So industry practitioners assumed, and I did too, if you listened to the August webinar, that the only way you could use that in-plan Roth correction method was if your plan allows for in-plan Roth rollovers. And the IRS said no. They said that you can still use the in-plan Roth rollover correction method, even if you don't otherwise allow for in-plan Roth rollover contribution. So some plans just don't want to be able to allow for in-plan Roth rollovers. You don't have to, but you can still use the in-plan Roth rollover correction method to correct any failures. The next change that the final regulations made was they provided us with more liberal deadlines for correcting these failures. So again, we've got the situation. Our highly paid participant made pre-tax catch-up contributions in 2026. They were required to be made on a Roth basis. Regardless of what limit we're talking about that's been exceeded, whether it's the 402G deferral limit, the 415 all-in limit, the plan imposed limit, or the ADP limit, the final regulations say that our correction deadline for qualification purposes is the last day of the next year. But if you've dealt at all with 402G refunds of excess deferrals, you know that those deferrals, those excess deferrals, need to be distributed to participants no later than April 15th of the next year. And so what the final regulation said was, even though for qualification purposes, you've got until the end of 2027 to correct a failure that occurred in 2026. If the failure results because there was some deferrals that exceeded the 402G limit of $24,500, we need to make that correction, just like we've always done, by April 15th of the next year. And if we don't take the correction steps, for example, transferring those pre-tax catch-up contributions from a pre-tax deferral account to the Roth deferral account, if we don't finalize those correction steps by April 15th of the next year, then there is double taxation to the highly paid participant. In other words, our highly paid participant is going to be taxed on those excess deferrals, both in 2026, the year of the deferral, and in 2027, the year in which those excess deferrals were contributed or distributed rather to our highly paid participant. And this is a rule that we've been dealing with forever. So it's not a new rule. It's just saying we've got to play by these deadlines to avoid this double taxation to the highly paid participant. Same sort of concept if we've got an ADP limit issue. So we need to make the ADP correction before 2.5 months of the next plan year, or 6 months if you've got an eligible automatic contribution arrangement. So any correction must be made on or before March 15th if you're an ADP tested plan, or June 30th if you've got an ECA. So if you don't make the correction by that 2.5 month into the next plan year, then there will be a 10% employer excise tax on those excess contributions that were not corrected or distributed to the highly paid participant within that 2.5 month period. The final regulations also give us a couple of exceptions when we don't need to make a correction. The first is if it is a de minimis failure, we don't need to make a correction. And a de minimis failure is where we've got the pre-tax catch-up deferrals that should have been Roth catch-up deferrals. If our pre-tax catch-up contributions did not exceed $250, we don't need to make a correction. The second is this idea that we learned late that we made a mistake with respect to our FICA wages. So let me lay this one out, is that let's say we've got FICA wages for 2025 of less than $150,000. So this person is not going to be a highly paid participant in 2026, meaning this person can make catch-up contributions on a pre-tax or a Roth basis. The correction period, if we get this wrong for qualification purposes, is December 31st of 2027. So now let's assume in 2028, we learned that there was a mistake in the FICA wages back in 2025, and our participant actually had FICA wages that exceeded $150,000 in 2025, and they should have been a highly paid participant in 2026. But what the IRS said is if you don't learn about this mistake in the FICA wages, if you learn about that mistake after the end of the correction period, you don't have to go back in our example to 2026 and make that conversion from pre-tax to Roth deferral account. You don't need to correct if you find out that FICA wages were wrong a year after, or rather after the end of the 1 year correction period. Next slide kind of gives us an example of this, the de minimis exception to correction. So we've got our 2026 deferral limit is $24,500. Our highly paid participant makes deferrals of $24,750 in 2026. The first $24,500 is not a catch-up contribution. The $250 above $24,500 is a pre-tax catch-up contribution, and we've got $15 in earnings on the pre-tax catch-up contribution. This would meet the de minimis exception to correction because that pre-tax catch-up contribution did not exceed $250. We don't care about the $15 in earnings. We're just taking a look at the pre-tax catch-up contribution, $250 or less, no correction needed. Next, we're going to talk about the client package that Union Bank provided to its clients that are using the Union Bank pre-approved plan. If you have an individually designed plan, you already have a working relationship with the attorney that drafted your plan. So if you are using an individually designed plan, you should talk to your attorney to make sure whatever pieces of paper or whatever practices you're going to put in place are designed to comply with the mandatory Roth contribution rules. So for our pre-approved plan clients, I wanted to walk through that client package that you received. The first is this practices and procedures document. So remember, we've got three ways we can correct a failure. We've got our highly paid participant who inadvertently made pre-tax catch-up contributions. We need to correct that failure. We can distribute those deferrals, those inadvertently made pre-tax catch-up contributions to our paid participant. But what we really want to do is keep those catch-up dollars in the plan. The only way to do that is through the W-2 correction method or that 1099-R in-plan Roth correction method. But in order to use the W-2 or the 1099-R correction methods, we need to have a practices and procedures document in place. The regulations say you need to have practices and procedures in writing that are designed to comply with the mandatory catch-up rules. If you don't have these practices and procedures in place, then the only available correction method is for the plan to distribute those pre-tax catch-up contributions, which should have been Roth catch-up contributions, to the highly paid participants. We're going to talk in a couple of minutes later about the choices made in the practices and procedures document that you're going to want to run by your payroll provider with respect to FICA wage aggregation, as well as those early year Roth deferrals, and we're going to talk about that in a couple of minutes. The next document that Union Bank provided to you was a draft letter that you can provide to your highly paid participants ahead of January 1st, 2026, that explains the new mandatory Roth catch-up rules. And you can also provide that letter to new highly paid participants who will first become eligible to participate in the plan on or after January 1st, 2026. The next document in your client package was the highly paid participant deemed Roth catch-up deferral election form. So let's talk about what this deemed Roth catch-up feature is. So what the regulations say is that we can put in place a deemed Roth feature, which says that you can provide to your highly paid participants this form that says, regardless of what elections you've made in your existing highly paid in your salary reduction agreement, any catch-up contributions will be deemed to be Roth catch-up contributions. So here's the idea is I've made $32,500 in deferrals, and they're all pre-tax deferrals in 2026. Let's assume I'm a highly paid participant. So now I have $8,000 in pre-tax catch-up deferrals. But through this deemed Roth feature, the $8,000 in pre-tax catch-up deferrals will automatically be treated as Roth catch-up deferrals, regardless of the fact that I have entered into a salary reduction agreement that says I want all of my deferrals to be made on a pre-tax basis. So that deemed Roth catch-up election says, no matter the fact that I elected all pre-tax deferrals, my catch-up deferrals are going to be treated as Roth deferrals. You need to have a deemed Roth catch-up procedure in place if you want to use that W-2 or the in-plan Roth rollover correction method. So that's what's behind the deemed Roth catch-up deferral election form that we provided to you. And you're going to need to provide that to your highly paid participants who will be new participants entering the plan on or after January 1st, 2026. And you're also going to need to provide that election form along with that letter to your existing participants who are going to be highly paid participants in 2026. Again, what that deemed election form says is that it will modify and overrule the existing salary reduction agreement to the extent that it conflicts with this concept that catch-up contributions need to be made on a Roth basis. So again, we're going to automatically treat any catch-up contributions as a Roth catch-up contribution unless the highly paid participant opts out of that deemed Roth election. So the question is, how does a highly paid participant opt out of that deemed Roth election? By checking and initialing the opt-out box in section 3 of that form. And I meant to say on the last slide, we recently discovered there was a typo in the first paragraph of that deemed Roth election slide. It mentions box 1, FICA wages. It should be box 3 of FICA wages. And we're going to be providing here within the next several days a corrected Roth election form that explains, that shows that it's actually box 3 in FICA wages that we care about and not box 1. So anyhow, so keep in mind what we're doing here. Any catch-up contributions are going to be deemed to be Roth unless our highly paid participant opts out of that deemed Roth election by checking and initialing the opt-out box in section 3. So if you hand out this deemed Roth election form to all your highly paid participants and someone doesn't return the deemed Roth election form, they have not opted out of the deemed Roth election. So any catch-up contributions will automatically be treated as Roth deferrals, even if they have an existing salary reduction agreement to make deferrals, all deferrals on a pre-tax basis. I think my recommendation would be, especially because we're talking about highly paid participants, is to try to get a signed deemed election form from all of your highly paid participants, regardless of whether they opt out or not. It might be difficult for larger employers, but it may save you headaches down the line when somebody at the end of the year realizes they've got Roth, $8,000 of Roth catch-up contributions, and they wanted all pre-tax. And if they had known about the rules, they would have just shut off their deferrals at $24,500 because they paid Roth. So I think I would recommend trying to get a signed form from everybody, regardless of whether they opt out or not. You don't have to, because again, the only way that these deemed Roth elections won't take place is if the highly paid participant affirmatively opts out of that. So there's this the idea of opting out of the deemed Roth election. So what the final regulations say is that the employer needs to give the highly paid participant an effective opportunity to opt out of the deemed Roth election. So that deemed Roth election form will satisfy this effective opportunity, right? Because you're providing that deemed Roth election form. It says, hey, if you want to opt out, check this box in section 3, and you've opted out. So that's where that effective opportunity requirement comes into play. So the question that has been asked is there an annual notice requirement to remind your highly paid participants that they have this option to elect out of the deemed Roth election? And the IRS was specifically asked if there was some type of notice requirement, and the IRS punted on the issue and wouldn't answer the issue. And they just said, when determining whether an employer has given the highly paid participant an effective opportunity to opt out of the deemed Roth election, that's a facts and circumstances test. So if the IRS comes to audit your plan, I guess effective opportunity is basically I'll know it when I see it with respect to the IRS auditor. And so actually, I've read even a couple of articles this week, and it seems like the industry is already coalescing around the idea that, yeah, it makes sense to provide an annual notice. And as I've been thinking about it, it is very similar in a way to our automatic enrollment, right? Is that in automatic enrollment, we do make an annual notice. We send it to all of our folks and say, hey, by the way, you're automatically enrolled. And if you want to opt out, you can. And I suspect this is really analogous to that. And so I do think it makes sense. I don't think it's required, but I don't know for sure if it is required or not. Again, it's a facts and circumstances test, but I do think it is analogous to an automatic enrollment. So I think it makes sense to provide an annual notice, reminding your highly paid participants that they can opt out of the deemed Roth election. I do see some changes coming in the deemed Roth election form. So the decision that Union Bank made was that we've got to put something in the hands of our highly paid participants who are going to be highly paid participants in 2026. And those are our existing highly paid participants. And so you could have put a brand new salary reduction agreement in the hands of every highly paid participant ahead of 2026. That might be a little burdensome since they already have existing salary reduction agreements in place. And so the purpose of that deemed Roth election form was to basically modify, as we said, and override any existing salary reduction agreement in place. So you didn't have to chase down every highly paid participant and have them execute a new salary reduction agreement. But I think going forward, and what Union Bank is going to do is actually create a new salary reduction agreement designed for highly paid participants. And what's going to be there in that new highly paid participant salary reduction agreement is we're going to incorporate the deemed Roth election rules inside of that new salary reduction agreement that you can use for new participants entering the plan. And it's basically just going to be a couple of boxes on there that says, hey, I'm a highly paid participant and I want my catch-up contributions to be made on a Roth basis. Or I'm a highly paid participant and I don't want to make catch-up contributions on a Roth basis. And if no election is made, then the deemed Roth election rules are going to come in play. And so I think going forward, that's going to be an easier route to go. But if you prefer, you can still use that deemed Roth election form that we provided to you going forward. But I think it might be easier for new participants to use a revised salary reduction agreement that incorporates that deemed Roth election inside that salary reduction agreement. And we're also going to make available to our employers an annual notice that they can provide to the highly paid participants. If you prefer, you can send out that letter that we provided to you for that purpose. But we will end up sometime next year getting to you a shorter annual notice that you can provide to all of your highly paid participants. So finally, let's talk about what you need to do between now and January 1st to be able to comply with these new rules. The first is, if your plan does not currently allow Roth deferrals, then your highly paid participants won't be able to make catch-up contributions in 2026 and beyond. So if you want to allow your highly paid participants to make catch-up contributions, you need to amend your plan no later than December 31st of this year to allow for Roth deferrals. So if you don't have Roth deferrals and you want your highly paid participants to make catch-up contributions, albeit on a Roth basis, please contact your union bank relationship manager as soon as possible so we can put together the amendment paperwork to amend the plan to allow for Roth deferrals effective 1/1 of 26. Most of the action items you're going to need to take between now and the beginning of the year is going to be working closely and coordinating with your payroll provider so you understand how this is going to work from a nuts and bolts perspective. First of all, everybody's going to need to know and to identify who your highly paid participants are for 2026. And this is going to be an annual step. You also may have some employees who are going to be close to that $150,000 mandatory Roth FICA wage threshold that you might not know until the end of the year. Make sure you talk to your payroll provider and you're going to get a report of those participants who are going to be highly paid participants and get that information, get that report immediately following the close of 2025. Also, you're going to have to let your payroll provider know that you have adopted the deemed Roth catch-up feature, right? Because we're automatically going to treat pre-tax catch-up contributions as Roth catch-up contributions unless our highly paid participant has opted out. And so I think you're going to also need to tell your payroll provider the names of those highly paid participants who are subject to the deemed Roth catch-up feature, as well as those highly paid participants who are not subject to the deemed Roth catch-up feature. And those would be your highly paid participants who affirmatively opted out of the deemed Roth catch-up feature. You're also going to want to understand, and your payroll provider is going to need to understand, is what's going to happen when your highly paid participant reaches their $24,500 deferral limit in 2026, because we want to avoid failures. We don't want to have to make corrections unless we have to. And so what that means is that if somebody goes over that $24,500 limit, we don't want those deferrals for our highly paid participant unless those deferrals are Roth deferrals. And those deferrals, those catch-up deferrals above 24.5 can be Roth deferrals through an affirmative election made by the highly paid participant or through that deemed Roth election. Also, we can take those additional deferrals if the highly paid participant previously made Roth deferrals in 2026 that we're going to treat as Roth catch-up contributions, right? That's that early year Roth that ordinarily wouldn't be a catch-up contribution, but for purposes of these rules, we can treat those early year Roth deferrals as catch-up contributions. Something you need to know when you're talking to your payroll provider. That practices and procedures document assumes that you're going to adopt that early year Roth deferrals practice. So again, we're going back to our example of that highly paid participant that makes the first $8,000 of deferrals in early 2026 as Roth deferrals. The practices and procedures document says we're going to treat those early year Roth deferrals as catch-up contributions, even though they were made before that $24,500 limit was reached. You need to talk to your payroll provider and make sure this is not an issue for them. Your payroll provider might say, that's just too complicated to be able to go back and figure out who made these early year Roth deferrals. We're not going to do that. And if they're not able or willing to kind of use this early year Roth deferral feature, then what you need to do is contact your Union Bank relationship manager and say, nope, we're not going to treat early year Roth deferrals as catch-up contributions. And so we need to know that so we can amend your practices and procedures document to say we're not going to use these early year Roth deferrals as catch-up contributions, and we'll also know how to perform compliance testing with respect to your plan. FICA wages for more than one employer. The practices and procedures document says we're not going to aggregate FICA wages when the employee works for more than one employer. Again, talk to your payroll provider. If the payroll provider says that is really difficult to do, we want to aggregate, and we are going to aggregate. And what you need to do in that case is, again, talk to your Union Bank relationship manager and says, yep, we're going to aggregate FICA wages when the employee works for more than one employer. We will amend your practices and procedures document accordingly, and we will know then how to correctly perform compliance testing, because you won't, rather you will be aggregating FICA wages. You also need to communicate with your highly paid participants ahead of January 1st of 2026. So send that letter to your highly paid participants and attach that deemed Roth catch-up deferral election form. I recommend sending it to your highly paid participants before December 1st, which is coming up. And for those participants, those highly paid participants that are going to first become eligible to participate in your plan on or after January 1st, 2026, put that letter and that deemed Roth election form in your enrollment kit to provide to those newly eligible highly paid participants. And again, we talked about an annual notice, and Union Bank's going to give that to you if you want to do that. The other thing, if you haven't done so already, and there's about 50 or so of our pre-approved plan clients who have not yet adopted the practices and procedures document. In order to use the W-2 correction method, and in order to use the in-plan Roth rollover correction method, you need to adopt the practices and procedures document no later than December 31st, 2025. If you don't adopt that practices and procedures document, then failures can only be corrected by distributing those inadvertently made pre-tax catch-up deferrals that should have been Roth, you're going to have to distribute that, and you can't keep those deferrals inside the plan. So if you want to keep catch-up contributions inside the plan, adopt that practices and procedures document. And then finally, I want to say Jason mentioned at the top of the hour that none of this is should be construed as providing legal advice, and I want to emphasize that these are new rules. Everything that we've done and put in your hands are certainly designed to comply with the new rules, but you really should talk to outside ERISA counsel and make sure that these practices and procedures, the deemed Roth election, and everything else works from the employer's perspective. So with that, that's the end of my prepared remarks. I'd be glad to answer any questions. If you prefer, as Jason said, you can always email me or give me a call at any time, and we can talk through any specific issues that you may have. So appreciate everybody listening. If you have any questions, let me know.
And before we get into the questions, John, could you go back to that disclosure slide, just because we also had, or the disclaimer slide, sorry. Okay. We also had quite a few people who showed up a little bit late, so I want to make sure they at least see that just for our own legal purposes. And as John said, the information that he just provided is for informational purposes only. So with that, let's open this up. I don't see anything in the chat boxes. If anybody has any questions, you can go ahead and unmute yourself and ask, or as John said, reach out to John or your relationship manager to get those answered. Does anybody have any questions? Oh, we do have one from the chat box. So the question is, will there be any flag to indicate to participants when they make their catch-up contributions to advise them it'll have to be Roth?
Will there be any flag to indicate to participants when they make their catch-up contributions to advise them they'll have to be Roth? I'm not sure exactly what you're thinking, but that letter to highly paid participants, along with the deemed Roth election form, is going to be enough under the regulations to put them on notice that they need to make their catch-up contributions on a Roth basis. Now, if you want to take more of a hands-on approach, and I think some of our clients that I understand are actually talking to all of their highly paid participants and making them aware of this. And so if that's possible in your situation, I would certainly encourage you to reach out individually to all of your highly paid participants and explain what's going to happen in 2026, right? Because these are your highly paid participants. Most employers don't want to irritate their highly paid participants. And so if you can, I certainly think it's a wonderful idea to sit down with your highly paid participants, individual or as a group, and say, hey, by the way, you made more than $150,000 in 2025. That means you're a highly paid participant in 2026. So if you want to make any catch-up contributions in 2026, they have to be made on a Roth basis. If you don't want to make catch-up contributions on a Roth basis, you need to let us know and we'll cut you off. But so the issue is if I'm a highly paid participant, if I want to make catch-up contributions, my choice is I make Roth catch-up contributions or I don't make any catch-up contributions. And so you just want to kind of make that clear to your highly paid participants. And so I hope that answers the question.
Well, I think maybe part of that question could be construed as they may not realize they're getting close to the threshold during the year. Is there anything that a payroll person should be or could be doing, or is there a flag that says, hey, you're getting close to the 24/5, and then reach out to that part?
Oh yeah, and I appreciate that, and I think that's your payroll provider, right? I mean, if you want to talk to your payroll provider and say, hey, by the way, on December 1st of every year, give me a report of anybody between, I don't know, $135,000 and $150,000 or whatever you think the parameters are. But this is really the employer working with the payroll provider and saying, hey, by the way, I don't really know if some of these people are highly paid participants, and get a report for them, your payroll providers, so you can approach those people. And you might want to, if you really won't know till the first week of January, you can always approach those people on the cusp there on the bubble and just say, oh, by the way, if your FICA wages are over $150,000 when all the dust settles, you're a highly paid participant. So I think that's get a report, work with your payroll provider to get a report for those people that are close to that FICA threshold. Thanks, Jason,
Yeah,
for the clarification.
So the next question was, can we get a copy of these slides? I included a copy of these slides within the email that I sent out this morning to everybody who registered. If you do not have that, you can go ahead and reach out to your relationship manager, and they can certainly get you a copy of these slides. Is there any other questions? At this point, I don't see any other questions. With that being said, any closing remarks, John?
Nope, Jason, I appreciate the assistance, and thank you again for attending. If you have any questions, give me a call or email me or talk to your relationship manager. Thanks a lot.
Thanks, John. Thank you, everybody.